Welcome to Stock Talk with Nico Kritikos. Today, we're going to be going over Ttcf and why I am bullish on this stock. So right off the bat, we can see here that I have 250 shares at an average cost of $17.38. And so I'm down a little bit on the position today. I actually bought about 20 more shares today, and the company reported earnings. And so they had record revenue of $59 million, which is up 44% from last year. However, they did miss numbers. They were expected to do $63 million of revenue, and they missed that. Then gross profit was up year over year to $6 million. However, the net loss was $8 million compared to $3 million in the year prior. And they said that the reasons for their profitability issues was because of inflation. They said materials and shipping costs and that type of stuff hurt their profitability, as well as they also made an acquisition with New Mexico Foods, and that's also was a big cost to them. But the market's kind of it's not really doing much. It's kind of just staying around this $16 mark. I take that as a positive, though. I love seeing companies make mergers and acquisitions. They just announced recently that they are also going to be purchasing Belmont Confections, a private label co-manufacturer of nutrition bars. And so this type of stuff I'm really excited about, because I like seeing a company adding to its assets and expanding its product line, things like that. So this is they said that it will further diversify its product offerings and enter into the $10 billion global plant-based bar category, aligning with Tattoo's Chef's growth strategy to develop more ambient and refrigerated products, unlocking more shelf space and expand its channel penetration beyond retail and club. So I like seeing things like that. We also saw earlier this year in the summer that they were going to launch into Kroger stores, which is the country's biggest grocery store chain. And by September, they got into 1,800 Kroger stores. Now, they're also in Target, they're in Whole Foods, they're in Sprouts, they're in tons of different grocery stores. They're in Walmart. And so that's why I really like this company, because they're growing fast. They're making lots of partnerships with smart grocery chains, and they're acquiring lots of brands, such as this New Mexico food company and a tortilla factory, which is, they said in their earnings that starting in Q1 of 2022, they will start operating 2 facilities for New Mexico Foods. And so they're having all these different, this is going to expand outside of frozen food and into ambient products like quesadillas, burritos, and other handheld items. So this is what I like to see, a company that's expanding their product line. They're going to offer new things, not just frozen products. And so that's first. Now, next up, we can go through Nico's stock market checklist and see how it performs. So is the stock down? Since this is a smaller cap company, it needs to be down over 35% to get a check mark here. And from its highs of $26, it is definitely down over 35%. So that gets a yes. Net income growth over the past couple years, we can find that right here, and we can see that net income has definitely been growing. This past year was kind of rough because they did have a bunch, they've been making acquisitions, they've been having inflation problems, but you can definitely see net income growing from 2018 to 2020. So we can give that a yes. And the other thing with a company this early on, you really want to make sure you're looking for, most of the time, these companies focus on revenue growth over profitability. You want to, expand your products, get into a bunch of stores, get the brand awareness out there. And then once you have high sales, then you start making your things more efficient and more profitable. So they are not going to have a profitable quarter every quarter right now, but the important thing is that they're expanding and growing their products. So revenue growth, yes, absolutely. Revenue growth has also been growing. A low forward PE, well, the stock's not profitable, so we can't do that. But so that's going to get a no, because it's not profitable. Is it innovative? Yes, it is innovative. They are making, they're taking advantage of the growing plant-based food market, and they're making frozen products. They're acquiring all these other brands like the nutrition bars and the tortillas and stuff, and they're making new products. So that's a yes. Now, how is the management team, and are they founder-led? Yes, they are founder-led by Sam Galletti and Sarah Galletti. And so that's something I also love to see. I like having founders as the executives and the CEO of the company. And so that's going to get a yes. That is a good thing to have. They also said some of the executives they have years of experience working at food companies. So that's a good thing too. Healthy return on invested capital. We can find that right here. Their return on invested capital is 9%. And we can compare that to something like a Beyond Meat. This is a good comparison because Beyond Meat is a bigger plant-based food company, and their valuation is extremely high compared to Tattooed Chef. Now, they are expected to grow a little bit more, but not by much. And they're also not profitable either. So we can see here that Beyond Meat is expected to do 41% revenue growth for 2022, and Tattooed Chef is expected to do 35% revenue growth. This year, they're growing 61%, which is crazy. And so, but relative to return on invested capital, 9%, that's okay. That's good for how early on they are in the company, though. But compared to Beyond Meat, you can see they're negative 10%. So that's pretty healthy. I mean, it's not 9% is not great, but it's better than Beyond Meat. And for how early on they are in their company's journey, it's not bad. Healthy profit margins. Well, they're also not profitable, but profit margin of 2.5%. For Beyond Meat, this number is negative 27%, also not good. So that's a tough one because 2% is not healthy. So we're going to give that a no. Healthy operating cash flow. Well, how I said, this company is still very early on, so it is kind of hard to tell, but it's going to be volatile in this early on in the company's journey. It's going to be volatile and things aren't going to be the same every quarter. But here we can see operating cash flow has actually been getting worse from 2019 to now. And so that's going to get a no. That's not good. But okay, is the industry growing? Yes, plant-based foods are growing. How is their balance sheet? Well, we can see here that equity has grown from 2019, $10 million in the balance sheet to now $234 million. We can also see that their current assets are bigger than current liabilities, and their non-current assets are bigger than their non-current liabilities. So that's good. Do they have a dividend? No. Do they have a share buyback system? Well, not exactly. They just went IPO they went IPO in 2018, but their share count actually increased by 189% this year. So that's not good at all. Then our hedge funds, big investors, or insiders buying. We can find that information here. We can see there was a little bit of insider buying in August of 2021 at $22 a share. Hedge funds, not really. They haven't really been doing much. So that's kind of a no. And then diverse revenue streams, yes, because of all the different products they have now. And then they're in all these different stores, as well as they have all these different products they sell, frozen food products, and they're expanding with these different brands. So this is going to be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So this is 11 out of 16. They missed it by 1. So technically this would not be a buy. And this is why I consider this a riskier position. So the stock's starting to move up a little bit after hours, but this is why this is a riskier position. But I'm very confident in this company. The plant-based food space is growing. More and more people are trying to incorporate that into their lifestyle. There's lots of vegetarians, lots of vegans, and especially compared to some of these other plant-based companies like Beyond Meat, the valuation is much more attractive. If we look at Tattooed Chef price to sales or price to book, we can see that those numbers are price to sales is 7, price to book is 6. Compared to Beyond Meat, it's higher than a 7 and a 6. It's 11 and a 21. So it's much, much higher. And so that's just something to take into consideration. So I feel like I'm taking advantage of the plant-based food industry growing with Tattooed Chef, and how I said I love seeing them get into all these different stores. They're in over 13,000 stores now, and I love seeing them make all these different acquisitions and mergers. They just started getting business through Kroger stores, and then they're also in Costco. They're in Sam's Club, and then starting in Q1 of 2022, we're going to see New Mexico Food start operating. And so, Yes, I'm very bullish on this company. Let me know what you guys think down below.